For more on where the industry stands, let's bring in Jade Rahmani. He's managing director at KBW, a Stifel company. Jade, great to have you with us. You don't think there's a soft landing ahead, but what does this landing, quote unquote, look like then? And how does it play out in the stocks you cover?
Well, commercial real estate is in the crosshairs, and for 2024, we do see turbulence. For you Taylor Swift fans, I would say, no, we're not out of the woods yet. We see further pressures on asset values down around another 5 to 10% for a cumulative 25 to 30%, and that will lead to credit pressures. There's 1.2 trillion of debt maturing over the next 2 years, and lenders are pulling back, including the banks as well as the non-banks. Fundamentally, right now, the CRE math is broken, with asset yields below borrowing costs, resulting in negative leverage. And therefore, this issue is going to come to a head. We're cautious on the commercial mortgage REITs in particular.
So I was looking at your coverage universe, and all of your stocks have a market perform rating or higher. None of them really reflect the sort of real concern that you have. Why is that? Is it just that you tend to cover a higher quality group, or are they somehow managing to buffer themselves against this?
Well, it's a mix of factors. On the commercial mortgage REIT side, the stocks are trading at approximately 80% of book value versus a historical closer to 1 times book value. So there's already some discount factored in, roughly 2 to 4% losses. We do have 2 underperformed ratings on CMTG and GPMT, but I would say we're not really recommending any stocks in the space. They also pay robust dividend yields, and while there could be dividend pressures, when we think about having more sell ratings, more underperform ratings, we would need further downside. We would need to assume some dividend cuts. So that's really why we have a neutral rating outlook. But within KBW's sector coverage, we do rate the commercial mortgage REITs as an underweight sector, and its commercial real estate finance is last of the sector weightings we recommended for 2024.
It's Karen. Thanks for being on. So we've seen this sort of iceberg coming for a while now, and we haven't yet seen a ton of. There's been a few big sort of bankruptcies, people just turning the keys back. How many years of sort of rough going do you think it will be to clear up this tremendous overhang of commercial debt, commercial real estate debt?
That's a great question. It's going to be multiple years because approximately 10% of the 5.8 trillion of debt outstanding matures each year. So there's a long cycle to this. And on the office leasing side, the leases tend to be 5 to 10 years on average. So you have about 12% of leases coming due each year. However, there was a record amount of debt issuance during COVID. And so we have a lot of floating rate debt coming due in the next 2 to 3 years, roughly 1.2 trillion this year and next. So I think that given the outlook for 2024 and 2025, we think the issue will come to a head in the more near term.
3 of your top picks are home builders, Horton, Lennar, and Toll. And I'm wondering, in an environment where it seemed like rates are going down, they looked great, but in an environment where rates may stay higher for longer, does that change your outlook at all, or is it all about just the inventory problem?
I would say inventory trumps rates. We actually came out with the 2024 outlook for housing in which we expect the existing home market to be flat and home prices to remain high. So that actually creates an opportunity for home builders. Over the last 10 years, their market share was around 9 to 10% and has recently increased to close to 15%. And we see them being able to maintain that 15% or higher market share and offer mortgage buydowns as a way to help bridge the gap for their customers. This results in, I would say, consistent gross margins, but strong sales, which will result in earnings and book value growth for the sector. So we are recommending the home builders.